Peace and blessings. Welcome to my channel. My name is Taj Yutsi, and I'm a certified financial coach. I am also the founder of TRU Financial Coaching, where our mission here is to educate, enlighten, and equip individuals with the financial literacy that is needed in order to get off of the rat wheel. What is the rat wheel? The rat wheel is when one is constantly financing things that go down in value for them, but up in value for the banks at the same time. The wheel is only powered as long as the rat is in motion. So when one is constantly financing objects that depreciate, then they constantly power that rat wheel. It's not until when one wakes up, realizes that they are the rat that's powering the wheel, that then they can create a plan in order to get off of the wheel. Once they get off of the wheel, then they become free to do what they want, when they want, instead of having to do the things that they don't want. Today's video, today's live stream is going to be a good one. And we have a special guest that I'll bring up shortly. But right now, before we bring up the guest, I want to thank you for those that are joining in. Want to acknowledge some ones that already came in, just see who they are, just put them up. We got Marvita. She says, "Greetings, brothers. Is it worth it? That's what I want to know. Please, peace be." So again, this is going to be a video on life insurance, and that was the title of this video: Life Insurance, Is It Worth It? We have Brother Ray, I believe that's Ransom. All right. Thank you for joining us. Greetings to JR. Judge Yourself says, "Greetings. We welcome you. Truth is needed." Greetings as well to you. Truth is needed. Biblical instructions before leaving Earth. Greetings, brothers and sisters. We greet you as well. Thank you for joining in. Brittany, thank you, Brittany, for joining us as well. Thank you, God for holiness. Says, "Greetings to you all." We thank you. And we have Cassandra says, "Greetings." Thank you, Cassandra, for joining. Keish Mitchell says, "Greetings" as well. And we thank God for everyone. Daughters of a King, Suzanne, Rain, Rizzy, greetings to you. Is it Rainy? Greetings to you as well. Fabian Spencer says, "Greetings." So again, we're looking to have a very informative discussion. Stacy Carter, thank you as well. And we hope that you enjoy this conversation that we're going to have. So I'm going to bring up my guest, my special guest, bring him up. And this is Brother Mark Marinnie Jr.
Yes, sir. Yes, sir.
Thank you, my brother, for coming on. We appreciate you taking the time out to be a part of this show.
Thank you for having me.
Yes, sir. And this is something that we've been planning for some time.
Yes.
I think back several months ago, we was planning it, and now it's coming to fruition. So again, appreciate you coming on. We're just have you take a few minutes just to introduce yourself. Tell us who you are, what you do, and what made you get into this space of finances and specifically life insurance.
Definitely. So as y'all know, my name is Mark Marinnie. This is kind of something that I would do on the side. I started really taking it serious when my father passed away in 2010. Or should I say that brought me the awareness of what life insurance was all about. And I seen how it kind of disrupted the family because he didn't have it. Or should I say, I believe his mother had it, but we didn't have access to it. So someone had to come along and pay. He couldn't even have a funeral. He had to be cremated. And just cremation alone, we're going back to 2010, that was about almost $3,000. And all they do is just burn the body up, put it in like a little vessel type looking thing, and then it's pretty much it's the individual's ashes. And the monies that were used to pay for your mortgage, the lights, had to be rerouted to pay for that. And of course, that messed up a lot. And this happened in the month of August. So you're talking about some of the hottest days in August, not having the air conditioner, things of that stuff, food spoiling in the refrigerator. And it was because we had no knowledge of exactly what life insurance was all about. So that was one of the biggest reasons. And obviously the legal money, and you were feeling like you were making a difference in people's houses and homes. And certainly in my few years, I've been doing this since 2014, when I got my license. So 2014, I'm actually planning on picking it back up because now I see the need for it is greater than it's ever been. So that's my story, and I'm sticking to it.
I thank you, brother. And so you talk about your father, not having a life insurance. What is life insurance? Just so people can get an idea, because a lot of times we talk about life insurance, people think it's just primarily for the burial, right? Because as you said, with your father, y'all had to cremate, y'all fully you couldn't do anything with the burial. So can you talk about what is life insurance and what's the benefit of having it?
So what is life insurance? Life insurance is just like any other insurance. We have mortgage insurance or house insurance, car insurance, cell phone insurance. I call it, when an individual have insurance, is to protect that individual if something happens. Even when you catch a flight somewhere, sometimes you can put insurance. God forbid you can't make it to that flight, you can get your money back. But if you don't put some type of insurance on there, then it's kind of, your money is gone. So with insurance is not only for burial, but it's also, I call it paycheck replacement. So if I have a wife, I'm making 50,000 a year, she's making 50,000 a year. That's a $100,000 lifestyle that we are living off of. You take away that 50,000, can my wife continue to maintain a $100,000 lifestyle? No, she can't do it.
Right.
So the purpose of life insurance is to bring that income back. So while I'm dead and gone, she can still maintain whatever bills she have going on. So it protects that individual's life in the case that they pass away. So that's really the purpose of life insurance, is just to protect the individual, not only get them buried, because there's cases where a husband or wife bury their husband or wife, and they got to go back to work in 3 days because the job is only paying them 3 to 5 days of bereavement. Can you imagine now your wife passed away, your husband passed away, and you have to go back to work in 5 days? Unbelievable. But if you had life insurance, now you can sit out, you make it take a month off because you have something to sit on, and if someone passed away.
That raises a good point. You're talking about the income protection component of it, which is really 100%. Because again, a lot of people look at life insurance as just for burial, right? And you talk about, you're working and having an income protect you from your income. But what about, let me ask you this. What about like someone that's not working, like a married couple, and you may have a stay-at-home mom? Like,
Good question.
how would that tie into with life insurance with a stay-at-home mom? Is that important for that mother to have?
Very good question. It's funny you asked that because I was just talking about this, and that's really probably a few days ago. So people say, well, she don't need it because she don't work. But keep in mind now, she's staying home in most cases because you have children. That's why she's staying home in most cases. Now, sometimes they stay home as just the husband and the wife, but in most cases, the stay-at-home mom because you have children. So God forbid she was to pass away, now you have to pay for childcare. And if you know anything about childcare for the parents out there, childcare is a lot of money.
It's like a
So
mortgage payment.
exactly, it really is. You're talking about, especially if you have a young baby, and now the wife or the husband is no longer here to be home with the kids. You still need to be able to go to work, so you have to pay for child. So you still want to have insurance, should be on that individual that's staying home, because that money now will go towards paying for childcare so that you can continue to work. If not, how are you going to be able to go to work and still have someone watch over the kids? Everyone's not fortunate enough to have parents or grandparents where you can let the kids stay with them. Most people, that's the reason why you have them in daycare, because they don't have nobody that they trust. So that's a big factor. So yeah, you certainly want to have insurance on that stay-at-home mom, because if she go away, God forbid, you still have income that you can pay for childcare.
Excellent. And we'll get into the amount of life insurance that you may recommend someone to have. But before we get into that, I recently did a poll on my channel, and in the poll, I had asked the question, "What type of life insurance do you have?" And it was four choices to select from: the term life, and we'll get into. You can explain the difference between each one, but we talked about term life and also whole life, and I put other because there are other types of life insurance outside
Correct.
term and life, term and whole, and then we said no life insurance. So let me just ask you, which one do you think had the highest result, and by what percentage would you estimate? And I'm gonna say this: let's say 50. It was 50 people. I'm just rounded because it was like 52, but we'll just round it to 50, right?
50
So, what percentage? Which one do you think had the highest percentage, and what percentage would you say that would be out of those four?
out of those four, I'm going to lean towards, just from my few years in the business, I'm going to lean towards no life insurance was probably the number one.
Ding, 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 ding.
Wow, really?
That is correct. What percent would you say?
Probably, I'm going to go as far as to say about 60%, 50 to
Wow, wow,
60%.
very good. It was 55%.
Wow.
55%. And this was out of 50 people, right?
Right,
52,
right.
52, 54 people. But 55%
Wow.
of the people polled did not have any life insurance. And
My goodness.
yeah, and what's ironic about that is I did the research just in the US, right? And how many people have life do not have life insurance, and the numbers were pretty much parallel. I think just in the US, it was maybe, I think, like 48% of
Almost half of the
individuals,
people.
almost half of Americans, exactly, do not have life insurance.
Wow.
So this goes back to your point about the importance of having life insurance, because, like you said, especially if you're the breadwinner of your family, right? Once you pass, your family's stuck. Because if you're the breadwinner of the family, and the family's depending on you, it's a single income household, and if you die, you're leaving your family with you know debt, right? If it's a mortgage
Yes.
payment, right? Car
Wow.
notes, right? The regular, just everyday utilities, so if you don't, out of those 52 people that just poll, if you don't have life insurance, this is the purpose of this live stream, is to educate you, right,
Yes.
on the importance of having it. So with that being said, can you
Wow.
talk to us about the different types? Like we said the poll was term. Surprisingly, and I'm gonna say surprisingly, term was number two, right? I think out of the
Wonderful. That's
poll I
good.
took, about 25% of individuals, right, had term. So can you talk to us about the different types of life insurance policies, term and the whole life?
Wonderful. So I'll definitely talk about that. I want to just touch base on what you just mentioned about 50, almost 50% of people had no life insurance.
Yep.
Unbelievable, because these same people had children.
Mm-hmm.
They have people that are financially being supported by their income. So this is why you see people making GoFundMe's.
Right.
Now imagine this now, your wife or your husband die, and the first, after they die, instead of you just being able to deal with the whole, setting up everything, you have to go figure out how to pay for this funeral.
Mm-hmm.
Just a funeral. We're not even talking about being able to live after. We're talking about just paying for burial.
Right.
And now you have to go have fish fries and sit on, often when I'm heading to church, I see people on Roosevelt Boulevard with the signs, with the picture of the person that passed away, trying to figure out how they're going to pay for that burial. That is unbelievable.
Right.
Hopefully we can help somebody out today with just the knowledge of what life insurance is all about. That's very unbelievable. But
Yeah.
fortunately, this is what's going on.
And also, like you said, I mean, you have individuals, that's one in two people, right? One out
Wow.
of two people. But yet these same individuals have insurance on their phones.
Yes. Insurance on your phone. Your cell phone is more important than your life.
Exactly. Insurance on Apple Watches, right?
Yeah, in fact, I got an older one. I got insurance on it. Something happened, I get it paid for. But yet, I always said to myself, I wish that they could make it legal. Like, you know how you can't drive without having car insurance.
That's right.
At least the minimum. So
That's
if you
right.
hit somebody, they stuff could be paid for.
Right.
Always wish that we were able to have something where it was mandatory.
Right.
And most people may say, well, it shouldn't be mandatory, but just think about, you will die. If God be, if God don't spare your life, you will depart this life.
That's right.
What is going to happen? The fact that we got more insurance on our cell phone and a little watch, and we don't have any insurance on our life, and a lot of it is just knowledge.
Right.
A lot of it is just knowledge. So to talk about the different kinds of life insurance. So now we know that it's a need for it.
Mm-hmm.
One of the life insurance I see a lot of people have is something called group life insurance.
Okay.
And group life insurance is what you get from work. So they call it group life insurance because there's a group of employees on one policy. So generally, when I sit down with people, the first thing, I already got insurance. I got it already. And they say, I got it through my job. So my number one question, I said, okay, could you go get that policy from me? Oh, yeah, I got it. Yeah, could you go get the policy from me? I'm asking this question because I know they can't get it from me because they're not the policy owner.
Right.
They can bring me back a certificate, but they will not be able to bring back the actual policy because they are not the policy owner. Mm-hmm. So the one now, again, anything free, take it. You at work and they're giving you it's generally 2 to 3 times your salary.
Mm-hmm.
And then many times you can opt for a little bit more. Usually very cheap. I always tell people, get it, but it should never be the only life insurance that you have. You should always have something that your own policy. Why do I say that? Because group life insurance is not portable.
Mm-hmm.
So what does that mean?
Right.
How many people nowadays are staying at their job for 30 and 40 years?
Not many.
Not many at all. So usually you see a better opportunity somewhere else. You're going to go to another job. And now you done spent 15 years at this one job. Keep in mind now, life insurance is predicated on 2 things, health and age.
Right.
So you're keeping in mind 15 years of good years have been gone. Right. So when you should have got it when you was a little bit younger, now you're in your 30s and 40s. And if you know anything, you know that as the body get older and older, do it get healthier?
No. Most people don't.
Most cases don't get healthier. Now you start dealing with things in your body that maybe you didn't deal with in your 20s.
Right.
And now this stuff is going to be predicated on health. So now something that you could have initially got for a cheaper price, now you may get it for a higher price, or in some cases, people get denied for life insurance, period.
Right.
So now you done been at this job 15 years, you go to another job, and now you're unable. Now you leave your family with absolutely nothing. So, group life insurance is usually one of the ones I see a lot of people have because it's free, and many times it comes with the actual employment.
Right.
Then you have term.
Before you get into the term, I'm going to touch on that group because someone I'm going to add this comment, and then I want to share something also. So this is to kind of tie into what you said, Sister Gervais. Forgive me if I mispronounced the name, but she said I paid insurance through an employer and lost it once I left the company, and that goes back to the point, right? To your point about it being portable, right? Once you leave, that's it. That's it. And not only that, but correct me if I'm wrong, there's cases where if you may, for example, like I'm a school teacher, right? So now for me, we had the same thing, the group policy. And what you actually put me onto it. So, and like for those that are listening, me and Mark, we have these conversations, right? This is not the first time we've had this conversation. This is something, this is just like something we do when we get together. But back during COVID, I think you have, brought to mind, you talking to me about life insurance. And I said the same thing. I have life insurance.
Yes, you did. Yes, you did. I remember that.
And you was like, well, you said you was real calm with it. You was like, well, just look into that, make sure. And I didn't really, pay it any mind until you brought it up. And as many people like doing that listen to my channel, like during COVID, that was my journey of like really waking up. The lights went off about my financial, uh, well-being. But when I went and did the research, I looked at my pay stub and saw, look, man, I'm only paying like $2, maybe $3 a
Yep,
paycheck.
that's right.
And then I said, well, how much is this policy worth? It was only worth like $25,000.
Wow.
$25,000 was the benefit. So if I passed, that's what my family would have gotten,
Wow.
which wasn't even not even half of my annual, pay, not even half. So, as you said, to your point with having insurance through your employer is good, but it shouldn't be the only source. It should just
That's
be
right.
a complement
That's
to
right.
whether you have your term or the other policy. We'll get into the other policies, but I just wanted to add that because I saw this comment um, and many people are in that same boat, right?
Oh,
Don't
for
even know.
sure.
They don't even
For
know.
sure. And even touching base with what we're talking about, I was looking at a case not too long ago where an individual ended up being ended up getting stage 3 cancer, I think it was stage 3 cancer,
Mm-hmm.
which means, because keep in mind the policy, in order for that group life insurance, you have to be actively on payroll.
Mm.
Make sure we understand this now. You have
Mm-hmm.
to be actively on payroll. So if you are out, like in this case, the individual had I believe it was stage 2 or stage 3 cancer.
Mm-hmm.
They can't work now. Now they're going through chemo, they're going through these
Mm-hmm.
different things. Guess what? It voids the policy.
Wow.
So you're with this company for 20 years. God
Mm-hmm.
forbid you've been diagnosed with cancer, and now you start going through your treatments. You can't work like how you was working because you are not actively on payroll. It voids the policy. This is why many times they send you something. I know in the state of New Jersey,
Mm-hmm.
they send you something called COBRA. I'm not sure if
Yes.
that's what happens in Pennsylvania as well.
Mm-hmm.
They send you something COBRA because now they're saying we're not covering nothing during
Right.
the time that you are out.
Right.
So now you can get, cancer hits all ages.
Mm-hmm.
So we can't think, oh, I got a bunch of years left. During that time that individual was out, he had a $1.5 million policy voided. Can't use it.
Wow.
So it's
Unbelievable.
very important. Yes, if you have it at work, go ahead and get it. Go ahead and get it. But
Mm-hmm.
also make sure you have your own personal outside of work.
Right. I'm gonna share one more question
Definitely.
before we get into the term and the whole life. Before you get into that, so this is from Cassandra. She says, "So for group, do I need to get a copy of the certificate? You mentioned the certificate, right? In case something happens to me, God forbid."
No. So a certificate is just them letting you know you have it. So you don't necessarily need it because as long as you're actively on payroll, they will be able to see. Like I had a case at work where in the beginning of August, one of my associates passed away. He passed away at work.
Mm-hmm.
He didn't need any certificate or anything like that. They was able to look at that and see that he was still actively working, and then the company covers that. So you don't necessarily need a certificate. It's just something that they give you almost like a receipt, but they call it a certificate.
Right. Got you. All right. Thanks, Cassandra, for that. All right. So let's get into the next type of insurance you was going to touch on was term life.
So term life. So there's different types of life insurances out there. The two main ones, you got term and then you have whole life or permanent life.
Mm-hmm.
They also is different variations of the whole life policy, which I'll talk about. But the first one I want to talk about is term. Term is literally probably, I believe it's the best one out there. I told Taj, I'm not gonna go in like I normally do, but I am gonna break it down and I will let the audience, once you hear the information, and everything that I'm saying is facts. And one of my favorite words, Snapple facts. You can actually, if you have one of these policies, you can open up that policy and you can go to the different pages and you will be able to see everything that I'm talking about. So we're not just talking out of our mouth. Term is just pure protection. Just like you have, like I mentioned, you got insurance on your house, have insurance on your car, you have insurance on your phone, on your watch. They have insurances now on appliances in your house. Something happened, is paid for. Nothing happened, nothing is paid for. Simple as that. Medical coverage, you pay monthly for that. But nothing happened to you, you don't pay anything. I mean, you pretty much don't get anything paid out to you. Something happened, you have that insurance in place to be able to take care of that. That's the same thing with term insurance. It's just pure protection. When you have just pure protection, you're able to get a whole lot more for your monies because it's pure protection. So I had a case where a young lady, she was paying $100 a month for a whole life policy. It was $100,000 policy for in her 30s, in her early 30s. So this was maybe about 7 years ago, $100 a month for a $100,000 policy. She could have been paying that same $100 a month. It could have had almost $400,000. That's $300,000 less that she left behind to her kid. That could have been way more than that, but it's all about the education, right?
Right.
She just didn't know. I know Taj talked about him being a school teacher. They have different classes and stuff that they teach. You ever wonder why they don't teach financial literacy? You ever wonder that? Like we being taught science and all this is good. I'm not speaking against education. I'm just saying I probably would have enjoyed financial literacy more than social studies. Yeah. Forgive me if I have any social study teachers in me. I probably would have enjoyed financial literacy more, but they're not going to teach you that because you start teaching people that if people knew better, they'd do better. I'm not going to teach you financial literacy because then you're going to make better decisions with your money. So, so the term is just pure protection. Something happened to you, is paid out. Nothing happened to you, nothing is paid out. That's essentially what term life insurance is. It's just a term. Sometimes you get anywhere from 10 years to 20 to 25 years. Some companies go as far as 30 years. But generally between 10 to 20 years of coverage. And the reason why they make it like that, there's something called the theory of decreasing responsibility. Okay. This says, so the theory of decreasing this responsibility is simply saying in your younger years, you're going to need a lot of money. Why? Because you haven't yet, you haven't yet earned a lot of money yet, invested a lot of money, saved a lot of money. So in those beginning years, you need something so God forbid you die, your family can be taken care of. Now, as you get older, there's a lesser need for it now because now you probably done paid off your mortgage. All the kids are out the house. So you don't need as much money as you needed in the beginning when you were first starting out with you and your family. So they call it the theory of decreasing responsibility. The older you get, the less bills you have. And now you can be self-sufficient now because if you invested the right way, now it would eliminate the need for life insurance and you can live off of your investments.
Exactly. And that's an excellent point. I'm glad you mentioned that. I'm going to hold that thought. We're going to hold that thought. Let's get into the whole life.
Whole life. Whoop, there it is.
We're trying to be as unbiased as possible. We're just sharing information. But
be as unbiased as possible. So whole life. Whole life is you have the actual life insurance component of it, and then you have the investment component. So whole life is bundled together with two things: the actual insurance and the investment. So the reason why this policy is sold many times is sold as an investment. It's not really sold for life insurance. It's sold as an investment, especially for those that don't know where to get a good rate of return at. Right. So this is why this particular product is still being marketed like it's marketed, because people, anytime you come to people, you're like, look, man, you can invest your money here, get this. That sounds good, especially when you go to the urban neighborhood.
Right.
Because we, unfortunately, in the urban neighborhood, many times we don't know where to get a good rate of return at.
Right.
So a whole life policy is sold as an investment. Now, here are some of the rules. I'll say it like that. Here are some of the rules that come with the whole life policy. The first rule, for the first 1 to 3 years, and if I have anybody on here with a whole life policy, I recommend that you get that right now so that you can actually follow along with what I'm talking about to see that I'm not just talking, but it's in your policy. Many times people don't read their contracts. I was talking to somebody earlier and I asked them, I said, you ever read your cell phone contract? It was like, no, most people never read the cell phone contract. It's still a contract.
Right. Exactly.
Still a contract. We don't know what's in the contract, but most people, so even with life insurance, people never read the contract. They just sign up for it. They tell them, look, this is going to get you this. If you do this, we go ahead, we put it away in a drawer somewhere, and it's never touched again until, God forbid, something happens.
Right.
So the first rule, the first 1 to 3 years. So remember now, in a whole life policy, part of your money is going to the insurance component. Part of the money is going to the investment component. So make sure you don't forget this first part.
Right.
Part of your money is going to the insurance component. Part of the money is going to the investment component. So for the first 1 to 3 years, all of the money that's supposed to go to the insurance or to the investment component goes directly to the insurance company. So it'll be equivalent to going to a bank and saving money with the bank for 3 years now. We're talking about 36 months of your money going into a bank. And imagine you go there on the third year and they tell you, you don't have any money in here. You're like, wait a minute. I've been paying this for 3 years. In your contract, no money is in that investment for 3 years. I don't know about you, but I don't see that to be a good investment, to be putting money into something. And then for the 3 years, I don't have anything to show for it.
Right.
That's the first rule. That's the rule that comes with the whole life policy or permanent whole life or permanent insurance. Same thing. So the first 3 years, that's the first rule. The second rule is, let's say now you start to earn some money. It's been a few years now, maybe 10 years went by. You got about 6,000 inside that policy, depending on how big your policy is. And now you're like, you know what, man, I'm getting some money in here. Generally, the interest rate on these things are between 1 to 3%.
That was going to be one of my questions.
That was the question you're about to ask.
I'm glad you said that. I'm glad you brought it up.
1 to 3%. Now, when you're talking about a long term, now we're talking, because that's what these policies are sold as, a long term investment. We're not talking about like a money market where I put some money in, I'm earning 3%. That's something like a short term.
Right.
We're talking about a long term investment.
Right.
3%. This is in your contract. Between 1.5 to 3% is what that money is earning, or what they're giving you, because they're earning a little bit more.
Exactly.
Because what they're doing is taking that money and they're investing it into the global economy.
Correct.
They're getting all this money and they're saying, we're going to give you 1.5 to 3% for allowing us to use your money. Just to kind of go off of topic for a second, it's just like taxes, right?
Yep.
People get so excited when taxes come back, but they fail to realize it's called a tax return.
Exactly.
They're just refunding back money that they took too much money from you.
That's exactly
throughout
right.
the year.
That's exactly right.
They took too much money for you.
Yeah.
They took too much, and they're saying, thank you for allowing us to use this money.
Right.
We invested it. We made money. We're just giving it back to you.
Right.
Without any interest.
Yeah. People get excited about that because for most people, that's the largest amount they're going to see one time in a year.
Yes.
But it's really your money already.
It's your money. Do what they do with it.
Yeah,
Take your own money.
Exactly.
Put it somewhere so that you can reap the benefits.
Exactly.
But unfortunately, we're not taught that.
Right.
So in this particular rule, the second rule is you earn between 1 to 3% on your money in that investment.
Exactly.
That's the second rule.
Right.
The third rule now is you can borrow. Listen to my term. You can borrow from the money that you have accumulated, right? Anytime you're borrowing something, what does borrow mean?
You got to pay it back.
You got to pay it back. So it's not your money you're borrowing, and you got to borrow it at a 4 to 6% interest rate.
Wow.
So keep in mind now, they're giving you 3%, but when it comes time for you borrowing your own money, you have to give them 4 to 6%. I can show you that in your policy. 4 to 6%. Let that rest with you for a little bit. So you're making 3%, but then to borrow your own money, you have to pay anywhere from 4 to 6%. The reason why I say anywhere from 4 to 6% because it varies from company to company. So there's not one standard number, but when you do the averages amongst all the companies, it's between 4 to 6%. That's the third rule. The fourth rule, I almost look at it like the fourth rule is probably the worst rule out of them all.
Okay.
And again, I'm being very unbunbiased here. I really am.
Just sharing facts.
I'm just giving the facts. That's why I keep telling you, go back to your policy and open it up and read it.
Right.
And you'll see what I'm talking about. So the fourth rule is, you would think now, let's just use just a general number, right? If it's 100,000, let's say you have a $100,000 death benefit. A death benefit is just a term saying life insurance. Right. That's the amount that my beneficiary would be paid, God forbid I was to pass away. Right. So let's say you got a $100,000 death benefit. And let's say out of the years you managed to earn about 20,000. Because the way that these things are set up is set up to when you hit 100, it's supposed to equal. That's how they set it up. Okay. So just keep in mind now, you didn't have this policy for 4 years. Keep in mind, you have something called inflation. Whole life policies don't take that into consideration.
That's true.
So $20 today is not the same thing. I remember my mother used to go in the grocery store for $20. We walked out of the grocery store with some bags. Now I may be able to walk out with some bread, eggs, and a soda. It's not the same $20 like it was years ago. So how can our life insurance be like that? Exactly. So now it's supposed to get, when you hit age 100, it's supposed to equal. Where you have 100,000 policy, you have the $100,000 in the investment. But here's the fourth rule that I'm talking about. You would think with the 100,000, let's just say I accumulated 40,000 so far, right? Right. Well, I should be paid. God forbid I pass away. My wife should receive 140,000.
Right. The $100,000 death benefit along with the 40,000 in investment.
The way that this rule works is no. He would receive the 100,000 and the company keeps the 40,000. I can show you that in your policy. So all this money now that you've been investing for all these years, your beneficiary would receive the 100,000 and the company keeps the 40,000. And just to take it a little bit more further, technically they're only paying 60,000 when you really look into it, because they're only giving you 60,000 because they accumulated the 40,000. Right. They're not even really paying 100,000. 40 of the 1,000 was what you earned. Right. So all they're doing is just paying you $60,000. Right. It's equivalent to going into a Foot Locker, buying a pair of shoes, but only being able to wear one shoe at a time.
That's a good way to put it.
You only can wear one shoe. You will never be able, in a whole life policy, you will never be able to wear both shoes. You only, if your family pass away, they pay the death benefit, they keep the investment. Or if you surrender your policy, they'll give you the 40,000, but it cancels the policy. Right. That's exactly how a whole life policy works. So now what they got very smart. They started coming out with different variations of it. Now the new kid on the block is IULs, which is very and that's something that's a whole different thing in itself. It's going to take time to break that down. But
what does it stand for? What does it stand for those that may not know? You said IUL.
Index Universal Life.
Okay.
And what that do is their investments is in something called the S&P 500.
Right.
So if you know anything about the S&P 500, that's like the top 500 companies.
Right.
That's pretty much making money, just to kind of like make it a little bit easier for everybody. Put it in layman's terms.
Right.
That's the top 500 companies.
Yeah.
And that deals with, but this policy is something, because as the policy grows, it eats at the I mean, it's a whole nother ball game that hopefully we could talk about that on another time or one-on-one. But just different, very same thing though. You have an investment and you have an insurance. And I keep going back to house insurance. Is there investment to it? No.
No.
Medical insurance, phone insurance, car insurance, you name it. Is there an investment attached to it? No.
No.
So why is there an investment attached to your life insurance?
Good question. Good question.
One of the reasons why this policy is still popular, because unfortunately some of these guys and ladies don't have securities license. So to have a securities license, what is a securities license? A securities license is the ability to move money. That's what a securities license is. You just can't say, oh, let me invest your money. You have to have a securities license to be able to do that. Only few people in the world have that. You know, believe it or not, I could probably, well, I ain't even gonna say that. I was getting ready to go in. You know, I go in when it comes to this whole life stuff. But a securities license, a lot of people don't have a securities license. So they market whole life. And I'm not saying people that market this product is bad. That's not what I'm saying at all.
Right.
Because most of them will tell you, well, people need to invest. Like, that's how they will look at it. Like, this helps people invest. So I'm not speaking against people that market it.
Right.
What I'm saying is check your policy.
Right. Yeah.
And if you're purchasing that product to protect you in your life, why would you have 100,000 when you can have 400 to 500,000?
Right.
Why would you have 500,000 when you could have put $1 million on your family? That's all I'm saying.
Yep. And I'm gonna get some comments because a couple of comments that I saw, but to kind of also go back to something you said about because a lot of people may say, well, I hear people say, I can borrow from it, right? I can borrow from this policy. Or I can borrow from the investments, right? Use the investment, borrow from it. Like you said, you're borrowing from your own money, right?
Your own money.
But let me ask you, suppose an individual borrows, right, from the investment and passes away with an outstanding loan, right? What happens?
So in a case like that, what they would do is they would deduct that money from the death benefit. So just to make math a little easier, if you took out 20,000, it would be 20,000 plus the 4 to 6% interest rate, or the 4 to 6 interest rate that you borrowed the money for.
Wow.
So now instead of your family being paid 100,000, now they're being paid 70-something thousand.
Right. The
Just
20,000 minus the interest is attached.
Minus the interest.
Wow.
Exactly. Doing that. This is
many people know that.
Policy. A lot of people don't know this. They think, oh, you know, it's my money, but again, borrow.
Right.
When you borrow something, that means you have to give it back.
Right.
So like Taj mentioned, you pass away, God forbid you pass away with that outstanding balance, they're going to deduct that from your $100,000.
Right.
And now your family going to have less money than what they had. And one more thing I forgot to mention, if you don't mind me mentioning this. Keep in mind for my husbands and wives out there, any debt that's accumulated with that spouse and they pass away, that debt now becomes your debt. So you can't look at it like, oh, they're gone. No, they're going to come after you now. Now you're going to start dealing with stuff like levies, which is a whole nother ball game. So this is why insurance is not just for burial purposes. Insurance is paycheck replacement. so that bills can still continue to be paid. So
Mm-hmm.
whatever bills that was accumulated with that husband and wife, you're not responsible for what they did before.
Right.
You're only responsible for what y'all both accumulated.
Right. Right.
That husband or that wife died. Now those bills are on you. So some people say, well, insurance is a little bit too much, but yet you got Netflix. You got the Beamer outside that costs
Right.
$48,000. You're eating out every day.
Right.
You're just spending money just on nothing. Like
Mm-hmm.
a place where I work at, there's people that buy stuff out of the vending machine. They're probably spending $200 just on that, just off a vending machine. So we have the money. We just have to do a better job
Exactly.
at where we're putting
Managing.
money at.
Yeah. I'm gonna share a couple of comments, some interesting ones. So
Wonderful.
yeah, share this. First is from Theo Howard. He says, buy term, invest the difference.
Thank God for Theo.
So this goes back to what you were saying and to the point that I had said, hold that thought on, because, and again, I'm not going to share either way. You know, the person has to make their own decision on what's best for them. Right.
Right.
But again, we're just sharing information, but this is, you know, to buy term, invest the difference, because as you said, with the whole life policy, they're investing money for you, right?
Right.
Whatever percentage may be. If you're paying $100 a month, as you use the example with the young lady that's in her 30s at $100,000 policy, right? I'm not sure what percentage of that 100 was going towards, but let's just say $60 was going towards the investment.
Yes, that's exactly how it works.
Yeah, and then $40 is going towards the actual death benefit, right? So at that age, it's no reason for you to be paying $100 for $100,000 life insurance policy.
I agree.
And I'm full disclosure, like after me and you had talked about my group policy with my job, I did the research, right? I went out and I got me a $500,000 policy, and at $44 a month.
Look at that. And how old were you?
That's what I was going to say next. So this was probably what, 2019. So I'm 49. So this was this 6 years ago, maybe 7, I think it was. So I was 42 years old.
42 years old. I need the audience to understand that. $42.5 million. So imagine if he got it at 24.
Right.
He would have probably had $1 million to $2 million under $100 because it's predicated on health and age. That is amazing.
Yeah.
At 42.
So, 42. So that's and I only did a 15-year term, right? Because, and this goes back to your point and what Theo was saying also, because I did a 15-year term because at the time, I think my youngest son was probably 13, right? So I figured let me do a 15-year term, because at the end of 15 years, he'll be 28, right? He'll be on his own. That was my youngest. So he'll be on his own, have his own life going and so forth and so on. But that gives me 15 years to do what Theo is saying.
Yep.
Buy term, right? Invest the difference.
That's the difference.
Where I can become, as you said, self-insured.
Yes.
But now I don't need the life insurance policy anymore, because my investments would, cover whatever necessities, expenses that my wife, would need after my passing. So
that is beautiful, man. Life insurance was never created to have for your whole life.
No.
Never was life insurance created for that. It was only created during those times where you were raising a family. Sometimes if you're a single person, sometimes people like to leave money because you still need to be buried. Right. So you still don't want to put your family in a position where who's going to bury you. So, people still get some type of coverage on them so that their mom or whoever their beneficiary is can still take care of them. Although they're single and they're by themselves, no one is financially looking to them. So, but you still want to have something so that you can still be buried. That is an excellent, excellent point, Taj.
Yeah. And I will say this, because I don't want people to think we're being one-sided, right? Because I will say, as you said earlier, insurance is predicated on two factors, right? Age and health, right?
Yes.
So for some individuals, if they get to the point where their health is failing them for whatever reason, term insurance would probably be difficult to get, or
Yes.
maybe high, right?
Very high.
So at that time, let's say someone might have a illness, terminal illness. Would whole life insurance be a good alternative in that case to term?
So it's funny that you ask that, because usually once people start getting up in age, they start getting in their 60s, and sometimes they start thinking about dying. And to get a term policy at the age of 60, it's not even like dependent. And now you got diabetes or whatever you're dealing with, different health issues. It's going to be impossible to get a term. This is why this type of discussion that we're having, it need to be, everybody need to be on this, listening to what's going on. Again, we're only talking about basic, we didn't want to speak over the audience here. We're just talking about basic stuff so that it can have your mind thinking like, you know what, we need to check to see what we have. But for an older person, so as much as I don't like whole life, and I'm saying me in particular, you still need something.
Right.
Always one of my sayings is oatmeal is better than no meal. Oatmeal is better than no meal. So you have different insurance companies that will take you on, but keep in mind, many times that's just enough to be buried. It's not going to be a significant amount of money.
Right.
Your average funeral cost now is hitting almost to $15,000 now. So back in 2014, it was $7,000. So you're talking about it over doubled,
right,
in just a few years. So that's the only time that I would recommend a whole life, is when they're in that situation. And really even that usually may be like $10,000 that they give the individual, but you're still paying a high premium.
All right, good. Share another comment. This is from Xavier Davis. All right. He says whole life policies with mutual companies pays dividends on top of the cash value growth and increases death benefits. So it depends. Check out the big four: Northwestern Mutual, Mass Mutual, New York Life. You understand what he's saying with that?
Yes. So Xavier, my question to you is, why wouldn't I just go and get a mutual fund outside of the whole life policy? That would be my question to you. Like, why would I take this particular route, if you don't mind me asking? Because I see what you're saying with the dividends, but we're still utilizing this whole life policy as an investment. So I'm still not yielding the amount of money that I would yield if I wanted to go directly to get me a mutual fund. And a mutual fund is a bunch of investments within that one mutual fund. So we have a big mall here in the Philadelphia area called King of Prussia. So a mutual fund, for those that's listening in, it'll be like I'm walking into King of Prussia and you have different stores. So I'm putting money in this store, I'm putting money in that store, I put money in the Apple store. So it's a bunch of investments in one. So my question to Xavier would be, why would I still use a whole life policy to do that when I can go to get a mutual fund that's been averaging about 10% for the last 60 years, when I'm going to get 3% for the whole life policy? The math is not mathing. Help me to understand that, Xavier.
All right, we got a couple of comments, and again, we're just sharing information, and there's nothing wrong with disagreeing, right?
Nothing wrong with that.
Nothing wrong with that, right? It's just sharing information. Just be respectful when we disagree, and that's good. Nothing wrong with that. This is a good comment. This is from Mark Robinson. He says, "What about using life insurance to establish generational wealth or generation wealth?"
So, Mark, this would kind of go back to what I was just telling Xavier. Nothing wrong with generational wealth, but would you agree that there's other vehicles that we can use to generate generational wealth? So if I'm going to use a whole life policy, and I just told you it's averaging between 1 point something to 3%, how much generational wealth am I accumulating with 3%? When I have mutual funds that's been averaging 10%. And then you have other things depending upon, again, we can't go too much into the investment side of this by law. We can't talk too much about the investment side of this, but just generally speaking, why would I use a life insurance policy that's giving me 3% when I can use a mutual fund? I'm just using a mutual fund just to kind of, that's one of the things that a lot of people can get their hands on, is a mutual fund, which is averaging 10%. Why would I go through? Is life insurance is just for that. It insures the life of the individual. So when you talking about generating wealth, why would I use the whole life policy when I have a low rate of return, when I can go somewhere else to get a high rate of return?
Okay. And I'm going to say this because I'm not sure if Mark is saying that in defense of the whole life. I think he might be just talking about in general. I may be mistaken. But if he is just talking about in general, right, whether it's a term life, right, or whole life, because when the death benefit, again, let's say, I'm going to just use me for an example, because somebody asked a question about where did I go. I'm not sure if I can say that, but I use Pacific Life, right? And I have a $500,000 policy. And when people hear that, or that $500,000 or $1 million, they think that it's going to cost a lot. And it really doesn't, right? Like you said, it's based on health and age. But to Mark's point and Mark Robinson's point, if I was to pass, right, that $500,000, if I pass within that term, will be passed, but my family will receive it, right? Beneficiaries will receive it. They could use that technically to help establish generational wealth.
Bingo. And that, you took the words right out of my mouth. So an individual, like we just talked about, the younger you are, obviously, the more coverage that you can get. So an individual can get $1 million policy. If they was to invest that $1 million policy at a 10%, if you can get, I have to use that terminology.
Right.
If you can get
right.
a 10% rate of return, that will yield that $100,000 a year for that spouse. So for Mark Robinson, yes, you can use your own money to do that. Term will get you the same thing. The money that will be paid out to your family, they can use that, they can invest that, and then that money will yield them that salary that the husband or the wife was bringing in, which will give them generational wealth. So Mark, you are right. I just wouldn't use a life insurance policy to be able to accumulate that type of wealth. So that's a very good question, Mark Robinson.
Yep. And another point to this question, we go back, like, and it's not even a race thing, right? It's just it's a knowledge thing, right? But it is statistically proven that African Americans don't have life insurance policies.
That's the truth.
Statistically, right?
That's a Snapple fact.
But even with that being said, we talk about using the life insurance or the death benefit to create generational wealth. Before you can even create generational wealth through a benefit from a life insurance policy, one must first create the knowledge level amongst their families. Because what good is it me passing down me dying and leaving my family a death benefit of $500,000 and they don't have the skills, right?
Well said.
When you're ignorant, you're going to leave bills. But when you're knowledgeable, you're going to leave not just money, but skills as to how to utilize that money to keep that generational wealth going beyond just one generation.
Well said, man.
So it's more than just passing down money also.
Yes. It's funny. You made me think about one of the sayings I would say, broke people leave bills, rich people leave wills.
Wills
Broke
and skills.
people, they leave bills.
Yeah, that's
But
true.
rich people or people that have knowledge of
Right.
money leave wills.
Exactly right.
And that's another thing, not only with the life insurance, but also we need to make sure for those that do have insurance, make sure that people know that you have it. So if you have a beneficiary, they need to know. If you do, I did a study a few years ago, and it was talking about how there's a lot of life insurance that's not claimed because the person never told the beneficiary that they were the beneficiary. They had the policy in place.
Wow.
They were paying like they were supposed to, but it was never paid out because the beneficiary had no idea that it was the beneficiary.
Wow.
So it's very important, if you do have it, make sure you have a talk with whoever have it, where however you want your money to be divvied up, make sure it's put in a will. One of the I remember we had a guy that came from a funeral home to speak. And the first thing he said was important. He said a will was more important than life insurance because that will, people need to know who get what. Because mama told me I'm getting it. She told her she getting, 5 of us are getting the same thing. But if it's in writing, now we know who gets what and what. But yes, that is so true. If they don't have the knowledge, I always say applied knowledge.
Applied knowledge. That's right.
Knowledge is power.
True.
But applied knowledge is
more powerful.
power.
That's right.
If you don't apply it, the application of that knowledge, it don't do you any good.
It's true. I'm gonna ask a couple more questions, but before I get into my questions, I just want to put this up because I thought this was a good comment. It's a good question, and this is from Thank You God for Holiness. Is it too late to ask your agent to change your insurance policy to terminate? I'm assuming that Thank You God for Holiness, you're talking about if you have a whole life policy.
That's what it sounds like.
Yeah, if you want to change it to. So can you explain that, Mark?
Yes. So you never ever want to cancel any policy. I don't care. Again, like me and Todd just saying, I'm trying to be, trust me, I'm normally would tear this thing apart. But I told Todd I'm gonna be nice. I'm just gonna speak facts so that you're able to go into your policy. It's a lie when I say it. It's truth when you say it. So like, you never ever want to cancel a policy until you have another one in force. So it's never too late. But this is why we're having this discussion, to bring the awareness, to what's going on. So what they're going to try to do is they're going to try to talk you into a whole lot of stuff because they don't want you to cancel this policy. Because in many cases, the agent that sold this policy to you, if you don't keep it in force for a certain amount of time, they get something called a chargeback. People in this industry are paid. So if you pay a premium, there's a bunch of people that get paid from that premium. So for the first year or two, the company's not making any money yet. They make their money off of what you're going to do going forward. Right. So if you cancel that policy, that agent gets something called a chargeback, meaning they have to pay that money back. Or when they make another sale, it's going to be taken out of their stuff. So is it too late? It's never too late to stop paying for something that may not be a good fit for you. And that's how I'm going to word it.
All right, good.
Never too late to cancel something that may not be a good fit for you. Just keep in mind with the policy, they may try to charge you to be able to surrender that policy, right, and get your money. It may be some type of penalty that you have to pay, but just make sure if you want to change it or cancel it, just make sure you have something else in place first. I don't care how bad the policy is, because you don't know, you can get hit by a car tomorrow.
That's right.
And if that policy is not in place and you cancel your current policy, your family still will get nothing. And like I mentioned, oatmeal is better than no milk.
I like that.
But
that's an excellent point.
Get something in place first. Once you get something in place, then you cancel the policy.
Excellent.
So to your point, it's never too late.
Right. Good. I got a couple of other questions. Let me try to get to other comments because there's some good comments I'm looking at.
Wonderful.
And then I think some of my questions might answer some of the questions that are in the comments as well.
Definitely.
So let me ask you, when is a good time to get life insurance? Like, is it ever a time where it's too early or too late? Like, when is a good time?
So there's never a bad time to not get it. I mean, meaning like it's never too early to get it is what I'm trying to say.
Okay.
Because keep in mind, the earlier you get it, the cheaper it is. So the way that they determine, especially if you're getting a term policy, they look at what one would pay on the average term. So something that this person may be paying $30 for 100,000, you may pay $12, $10 for the same policy that somebody else had. So it's never too early, especially once you start getting of age. You know, you're 18, 19, 20, you may have a mind and want to start a family one day. Man, it's best to get that policy ASAP. That way, the earlier you get it, the cheaper it will be. Like I said, it's predicated on age and it's predicated on health. Right now, you're at your healthiest at the age of 19, 20. That's the best time to get it.
Right. And I even heard of cases where individuals have taken out policies on their newborn babies.
Yes, I heard of that too. Usually it's a whole life policy.
Okay.
And most people are familiar with that company, Gerber.
Okay. Yep.
So usually Gerber.
Somebody put a question in there about that. I was going to try to bring that up.
So I won't talk too much about it now, but usually people, keep in mind, babies unfortunately pass away too.
Yeah, right.
And you still want to be able to give whatever, however you do it, whether you want to have a funeral, but it still costs money to put people in the ground.
Right.
So we definitely, now you're not going to put a $100,000 policy on a baby,
right? Exactly.
But you want to have just enough to be able to bury the child.
Right.
So
exactly.
Yes, I would do that.
All right. So that kind of answered one of the questions someone had put in here about with the Gerber. They actually used Gerber as an example. I was trying to see if I can.
Now, I want to touch one more thing about that particular situation. So you won't get an individual policy. So in the insurance world, there's something called a rider. It's called a child rider.
Mm-hmm.
So it's almost equivalent to having a pizza. So the pizza would be the life insurance. The pepperonis would be the rider.
Right.
So it would be like very, very cheap to have the kids on the same policy, because what me and Taj talked about, you also run into people that have multiple policies.
Mm-hmm.
Well, they got a policy here, they got 3 and 4 policies. No, everything could be on one policy, and you could be able to put that child on your same policy. It's called a child rider.
Yeah. So this goes in. This was asked by Steph's Health Matters. And she said, could you speak about the insurance for children, like the Gerber insurance, et cetera, which you just touched on?
Yeah, pretty much. Yeah. So I'm Gerber is probably, because you run into grown adults that still have Gerber. Last time I checked, I think Gerber was like a baby product or something, baby food or something. People are 40 years old and they got a Gerber policy because it's something that their mother put on them.
Right.
We want to get away from things like that.
Yeah.
Whatever policy that you have, you can add your children. What I talked about is called a child rider.
Yep.
It'll be like the pepperonis. You already have the pizza already. Right. It'll just be like the extra stuff that you put on. So you can speak to whoever your agent is and ask them, you want to add your child on to that particular. If they don't allow you to do that, you probably want to run away from that company.
What's the age for that? Like
so
the max when is it cut off where you can't add them as a rider?
So it generally till and some companies do 25 days. So when the baby's born, at least 25 days to the age of 18, or if they're still in college. So if they're still in school, until they graduate from school, and they got to be living under your roof.
Okay.
Or under your roof. So from 25 days old to generally to 18, or if they're still in college.
Okay, good. And again, that's called a rider. They also have, some even offer spousal riders as well.
Yes. Oh, for sure. Yeah. Oh, yeah. The rider covers both spouse and children, but yeah. And again, it just adds it on to the policy that you already have enforced.
All right. Excellent. Question I have, again, we talked about it earlier when me and you was off, before we got on. How much life insurance or what's a good rule of thumb for an amount of a life insurance for the death benefit that one should take out?
So the rule of thumb is between 7 to 10 times your annual salary.
Mm-hmm.
So like I mentioned with if you make $100,000 a year,
That gross or net?
so usually you want to do so it kind of can go back to, and that's why I say 7 to 10,
Right.
because some people may do gross, but
Right.
you're not technically bringing home the gross.
Right.
And the thing about life insurance, when it's paid out, like they're not going to tax that.
Exactly. I'm glad you said that.
That's a big component of that.
Yes.
So they're not going to tax life insurance proceeds. So I would say between, and not just me, the rule of thumb is 7 to 10 times your salary. That way your family know for sure that they will be able to continue life. This to give them opportunity to be able to pivot, do something different. But to have 7 to 10 times, it goes back to what I said at the beginning, where imagine now the spouse passes away and you got to be back to work because you're already living paycheck to paycheck because you didn't discipline your money. So you're already living paycheck to paycheck. So you cannot afford to take days off from work.
Right.
So they're only giving you 3, some companies 5 days of bereavement. After that, you have to not only deal with setting up this funeral, but you got to deal with going back to work.
That's true.
So this is the purpose why you want to have 7 to 10. You may be able to take a month or 2 off, right, where you could just, deal with you so that you don't go to work and get yourself fired because somebody said something they weren't supposed to. So you have to think about all of that. So the general rule of thumb is 7 to 10 times your annual salary.
All right, excellent. This kind of ties into the next question I was going to have. I'm going to share this comment. This question is from Kenya Grant. She said, does it make sense to have more than one policy?
It makes no sense, Kenya. That is a very excellent question because most companies, I won't really mention their names. Now, when we're speaking good about a company, I'll mention their name, but
right.
Out of respect, because it may
Right.
be some agents that work
Right.
for that company.
Right.
And one
Right.
thing me and Taj don't want to do is offend anybody.
Right.
We just want to give you facts that you can open up and read, and we'll go from there. But there's one major company that's in the state of New York. And I'll say that they're in the state of New York. And the way that they market their policies, they would, if you got a husband, wife, kids, they would give them 3 policies. That's not how you want to do it. You want everything can go on one policy, but guess what? The agent will not tell you that because they make more money off of more policies that they give you. Many times it's your own family members, it's your cousins, your friends. The more policies that they're able to sell you, the more of a commission that they get. So they're not in the business of losing money. Like, wait a minute, I can give you this. That's why when I run into these situations, I say, are you still cool with this person? I ask that so that I won't say nothing where they call them and be ready to fight. I usually ask, are you still cool? Because there's no way you could be cool with this person and this person just sold you 3 policies.
Right.
And they could have just sold you 1 policy.
Exactly.
Saved you money. So Kenya, to your question, does it make sense? No, it do not make sense. 1 policy is good enough for you, your husband, your family, your wife, your kids. Everybody could be on that 1 policy.
Right. And I often say, if it doesn't make sense, it doesn't make sense. CENS.
I like that. I'm still in that. It doesn't make sense. It doesn't make I like that. I'm still in that. Put that on a t-shirt. Put that on a t-shirt.
And that's the truth, because and like to your point again, the knowledge. It's the knowledge. The more you know, the better you can do, right?
Well said.
And like I said, I'll share my journey on my channel, and it's not even about income. It's not about your position on your job, right? The knowledge is important. And before COVID, all I had was the job insurance. I thought that was sufficient enough, not even realizing until me and you just had a flyby conversation, just talking, that look, now this is not good enough. So the more we know, again, like you said, knowledge is power, but knowledge is power, but the application of that knowledge is more powerful.
Wonderful.
And, like I said, many people look at life insurance like you got to have, you got to be paying a whole lot of money. You got to have an income of a certain amount. And that's not true.
Not
right?
true at all.
Like I said, life insurance policy, $44 a month is what I'm paying. You just put that in your budget. And that's another thing. We won't go deep into that, but for some people, it may look like they can't afford it, but you can just go through your bank statements,
That's
see
right.
what you can cut out, create a budget, include that in your budget. And you don't even think about it.
That's
You don't
right.
even think about it. So
Well said, man.
it's something that's very important. And I'm thank you for, we've been talking about this for some time, but to see this coming on, this is a great help to many. And we'll get to some of the comments. I want to share this one comment. This is from Arch392 Scat Pack, I believe it is, and this kind of goes back. They say the wealthy doesn't have life insurance. They have assets which generates income. For those who have not built wealth yet, they may need life insurance. I'm gonna say they may need, is not they may, they do need.
You need it. But I see what
it's a good point. It's an excellent point, though.
Excellent point.
Right?
Excellent point.
The wealthy don't use it because they created, and that goes back to what we were saying earlier about being self-insured.
Yes.
Can you speak on this again?
So it's funny that they said the wealthy don't use it. Believe it or not, some of the wealthy do use it for tax purposes because they're able to hide money in these policies. So they do use it, but not like how the general public will use it.
Exactly.
They use it for tax purposes to try to avoid, just like you see people, you're like, oh man, they always giving. I'm not going to say many of them are not sincere because I don't know their hearts, but some of them, it's a tax write-off. The more money that they can write off, the more money that they can keep. So believe it or not, some of the wealthy do use it, but not how we use it. They use it for tax purposes. But for the question, for the last part, you said for those who have not built wealth yet, they may need life insurance. And like Todd said, not that they may need it, they do need it. Mm-hmm. Even like we mentioned, a man that has a wife that stay at home, you would think that she don't need a policy on her. She do need a policy on her.
Sir.
She really do. And life insurance, again, is to protect income. I call it paycheck replacement because that's exactly what life insurance do. It replaces the individual's paycheck. And God forbid something happened to them. So hopefully I answered that question.
Yeah. And again, to your point about, because especially when you have like stay-home moms, right? Some men, well, she ain't bringing nothing to the table. She is bringing something to the table.
Yes, she is.
Right? You don't realize how much you're saving by having your wife stay at home to, rear the children. So even as you said, with the rule of thumb of 7 to 10 times of your income, right? Even if you have a stay-at-home wife, right? A mother that's staying at home with the children, does that rule of thumb still apply 7 to 10 times? And what would be used to measure that 7 to 10 times?
So if I'm putting money on the spouse, I'm going to be looking at what does it take to pay for daycare now. I'm going to also take into account inflation. So you may be paying this now, but what about 2034? If God spare your life, allow you to live to then, obviously it's going to be a little bit more. So I'm going to take those are going to be all factors that I'm going to take into account. So the 7 to 10, I'm talking mainly on the individual. But now if you have a stay-at-home wife, and this is why everybody should sit down with a financial coach, everybody, because there's not one plan for everybody. It's literally, it's almost everybody have their own plan that will be catered to them in particular. So yes, the 7 to 10 times I'm speaking about is on the individual, but you also want to take into account the stay-at-home wife. She may not be bringing in the income, but you want to think about childcare and how much that's going to cost for the next 10 to 15 years.
Right, exactly.
Take into account inflation, and that will give you your number on how much you need to put on her.
Good. Excellent. I'm going to share a couple more comments. Probably try to go maybe 10, 15 more minutes, but I'm going to share a couple more comments.
This is good.
Yeah, this is good. This is good. Kind of ties into what Arch 392 also said, wealthy, and what you were saying also about how the wealthy use. So this person says wealthy use, Xavier Davis says wealthy use life insurance inside of irrevocable trust. It's called ILITS. Are you familiar with that?
I'm not familiar with that, but it looks like if they're using that, it's still going to be some type of investment component to it. So like I mentioned earlier, there's different types of whole life, because the actual whole life in itself, like I mentioned, is bundled together with the insurance component and an investment component. If anything is generating any type of income on a policy, no matter what they try to, if you put lipstick on a pig, it's still a pig.
Still a pig.
Still a pig. You put lipstick on a pig, it's still a pig. So they can call it whatever they want to call it. It essentially, there's going to be different variables that comes with it, but it's essentially an investment and a life insurance that's going to be bundled together.
Excellent. So he says that ILITS are income tax free and estate tax free. I'm gonna say this. A lot of times people always talk about, well, the rich do this, the wealthy do that, right? They're rich and wealthy for a reason, right? They didn't just, in a lot of cases, they didn't just get to that point.
Well said.
Right? They acquired, they may have started at where the average Joe is at.
That's true.
Acquired knowledge and then began to apply that knowledge. And, as you said, for a lot of the wealthy, they use whole life policies as the last vehicle to shelter their money.
Well said. Shelter. That's exactly what it is. It's a shelter. It's somewhere they're hiding something, but it's legal.
Exactly. It's legal.
It's legal. Well said. Shelter.
Right. So, and this, again, it's nothing, if you know how to use, a lot of people don't know, like Trump, but Trump made a very good comment one time years ago. He said, I just use the system that you guys created. Yep. I just find loopholes in the system that was created, because people was jumping on Trump about, well, he only paid X amount of dollars in taxes, but the system was designed to do that, right?
Yes,
to protect the taxes. So if I can use the system in that manner, I'm not breaking any rules, right?
He told the truth.
With the whole life policy, when people always talk about the wealthy, right? They use these vehicles, they use these tools for that purpose. That's what they use for. True. And it's just like, just not to get off topic, but with like 401ks, right? A lot of people with 401ks, when you go on your job, you might get a match, right? I say that the match is just the icing on the cake. The true benefit of the 401k is to protect from taxes.
Yep.
The match is, most people just look at the match.
That is true.
But the true benefit is the tax.
Yep.
And this is how the quote unquote wealthy utilize these vehicles to build wealth. Right.
Well said. Well said.
Very good question, Xavier. Go ahead. What'd you say, brother? I missed you. What'd you say?
No, I was going to say very good question, Xavier.
Yes, sir. Well, excellent. It was a couple of other people. This all goes back to the Gerber. My mother has me paying for a Gerber grow up policy right now. Kids are over 30 plus. So,
and now think about this now, over 30 plus, right. You probably don't have no more than $1,000 and something in that policy.
Right.
Because it's generating very little rate of return. Exactly. So, but that's what I was talking about though. A lot of people have a Gerber, but it's still not enough. So that's a good call out, Terrence.
This is from Theo. It's a good, and I'm glad he put this because you talk about people having life insurance, but their beneficiary is not even aware of it.
Right. That's true.
So this is something he says you can, and I'm familiar with this. You can check the NAIC to find out if a deceased family member has a policy for you. It takes some time before they get back to you, but
right.
You could.
They will eventually get back to you.
Yeah,
But
that's
definitely a good call out on that one.
Yeah. This is from Vanessa Boyd. She says, "Wow, this was so helpful. The only life insurance I have is from retiring from my job 6 years now. I often wonder if I should get another life insurance policy. I work for a municipality. Am I good?"
So it's going to be, so if you're talking about retirement, so now again, some people retire early. So I don't want to make the mistake to say that you're in your 60s because you retire. You could have retired in your 30s. Some people are able to do that. But I always say you have a 50% chance if you take the shot. You have a 0% chance if you don't. So I would certainly start looking to shopping for some life insurance. I will also recommend that in order for you to see whether or not you're working with a good company, there's something called AM Best. And what they do is they rate the financial strengths of these companies. That simply means if something was to happen to you, do that company have the money to be able to pay out their policy? So like you've seen a lot of policies during the Twin Towers. I believe that was 2001, if I'm not mistaken. Yeah. There were some companies that was not paying out the policies, believe it or not. Wow. So AM Best is one of the companies that you want to look at to see. They kind of rate the financial strengths of a company. You can also look on the Better Business Bureau. And now some people try to do little stuff. They send stuff there, but the Better Business Bureau is set up for the consumer to make sure that business is being done the right way. So that's the two things you want to look at when shopping for a life insurance policy. So to your question, even though you've been retired for 6 years, I would still start shopping. And you want to get enough. If someone is financially dependent upon your income, obviously you want to make sure that you have enough to give to them. Or if you're just worrying about yourself being able to pay, I would definitely start shopping for some insurance.
Excellent. All right. We got another comment. This is from Suzanne N. And this is, I'm assuming, pertaining to the term life. After the 15-year ends, what do you do? What do you do with what you accumulated, if not use? What are the options? So I'm assuming she's saying once the term ends on the policy, what happens next? Where does that money go? What are the options after that term policy ends?
Good question, Suzanne. So we kind of mentioned it. Someone said something earlier. They said buy term, invest the difference. So in a term policy, something that somebody's paying $100 for a whole life policy, they'll pay about $20 for a term policy. That's the numbers, between $20 to $30 that somebody's paying $100 for. So what we're saying, buy term, invest the difference, that's $70 that you would have been paying. If you're investing that into a mutual fund where you're getting a rate of return, if you can average a rate of return of 10% over that 15 years that you have accumulated that wealth, and now when that policy is up, it goes back to what I mentioned about the theory of decreasing responsibility. Obviously, it's a theory, but it's a very good theory. All theories are not wrong. There are some theories that are right. There's a whole bunch of them that's wrong. But the theory of decreasing responsibility in 15 years, Suzanne, I'm thinking that 15 years, someone like Taj talked about, his son was 13. He put 15 years, his son would be 28, I believe he said. He will be self-sufficient, able to be out on his own, God be his help. The 15 years, the insurance, just like car insurance. What happens if, there's some people that never had a car accident before and had insurance for 20 years, never had one accident. And you got somebody that had insurance for 1 year and they had to use it. So that's all insurance is. It just pays out whatever. If you get into an accident, it pays out. God forbid you pass away, it pays out. In this case, there's options to be able to get some more for a few more years if you wanted to. So you're not just out. And even if you're older, because you're already under that policy, most companies would allow you to actually, it's called, they got some, so all insurance companies are not the same. Let me start by saying that. It's just like I can go buy a Toyota, but a Toyota is not like a BMW.
Mm-hmm.
A Honda is not like a Lexus. So there's maybe more bells and whistles in this case, less bells and whistles in this case. So to touch on your point, after the 15 years are up, you generally can get more if you wanted to. Todd was able to do that because that's his situation.
Right.
But some people may get, like I normally recommend people get 25 to 30 years. But Todd did that because that's his situation. It was tailored to him and his family. So you don't really want to go off of, you need to see what is more beneficial for me to get. So in your case, Susanna, you may need to get 30 years. Maybe you need double what Taj had. Now that'll help you build in. You're investing for 30 years. You're going to have a nice nest egg that you can be able to say, you know what, I can get rid of the insurance. I done built up this nest egg for 30 years. So 15 years is a good starting point. And depending upon, remember, Taj's kids are a little bit more older too.
Right.
He's not dealing with a 4-year-old. Now, if he had a 4-year-old,
right.
he probably wouldn't get a 15-year policy. Exactly. So all of this is going to be predicated on your situation and your family. So hopefully that helps.
Yeah, and I'm glad you said that because, again, life insurance is a part of personal finances, right? And I often say personal finances is just that, personal, right? It's personal. So we're just here to share information, to enlighten. As I say, TRU Financial Coaching, that's what we do. We enlighten, we educate, and we equip individuals with the financial literacy that is needed in order to get off the rat wheel, right? So that's what we're doing here. We're enlightening you, we're educating you and equipping you, but you ultimately have to make that decision based upon your situation.
And I just want to add one more thing with that. Yes. The last part of that question was, what are the options? The options are, so this is my fight that I have with whole life agents. This is the fight. We always go back and forth because this is what they come at me with. They say, well, what about after the year is over? Right. They ain't got nothing. they had the whole life policy. It was still such and such and such and such. But insurance, you're getting the term, but you also want to make sure that you're doing the other part of it. It's not just buy term. Right. It's buy term, invest the difference.
Exactly.
That's the key. If you're just going to buy term, right, then it may not be a good fit for you because you're just buying the term. Right. But you want to buy term, and the money that you would have spent in a whole life policy, you go get yourself a good rate of return with a good mutual fund somewhere. So you want to make sure that you're doing both. Exactly. If you're only doing just one and you don't have the finances that been accumulated throughout the years, you will be in some trouble if you only got 15 years. Right. But if you plan,
exactly,
that will be your option. You want to take that money, you want to invest that into the global economy yourself. And now when you get to that 15 or that 30-year mark, you would have built you a nice nest egg that you can be able to live off of. Yeah. Hopefully that helps.
And that's an excellent point. You know, and again, this goes back with what I teach. It's very difficult to invest in something outside of yourself if you haven't yet first invested in yourself. And this is where creating a budget, right?
Yes.
It's getting an emergency fund, a starter emergency fund, eliminating that high interest debt, right? Because it's impossible to get a policy and invest the difference, right? Yes. You can get the policy, but you'll have a difficult time of investing the difference if you have a whole bunch of consumer debt.
Well said. Well
said.
So
once you eliminate that, once you get, you get your policy regardless, right? Like you said, no oatmeal is better than no meal. Right?
That's a true statement.
Right. So you get your policy, right? But in the midst of that, you should also, again, create the budget, right? Get that started emergency fund. Focus on eliminating all that high interest debt.
That's right.
Then you can begin to invest, right? Build your emergency fund up a little bit more, then invest. Because saving and investing, a lot of people don't look at that. Those don't notice those are two different things.
Two different things.
Right? Saving, okay, I can save my money in a bank account that's going to pay me less than 1% interest, or even if I put it in a high yield savings account, 3.5 to 4% interest, right? But that's just keeping up with inflation.
That's right.
And as you said, with that whole life policy, that investment piece is only 1 to 3%.
That's right.
Which is just, again, barely keeping up with inflation. I believe inflation is like, what, 2.5 to 3% annually?
And it seemed like it's increasing more and more.
Exactly. So now what I can do once I, go through these steps. And one thing I remember you said to me, and like I said, I think me and you talked, but you played a very integral part on my journey. I don't know if I shared that with you before, but
I appreciate that, bro.
You played a very integral part on my journey, really. But I remember one thing you said in the midst of one of our conversations years ago. You said, even an elephant
can eat the elephant piece by piece.
Right? One piece at a time, right? And for many with that big, large amount of debt, you can knock that out. You just got to do it, here a little, there a little.
That's right. And be consistent.
That's the key. That's the key. But if I have all this debt and I'm still accumulating debt and I'm not working to paying that debt down, I can have the first piece, the life insurance, but I'm not going to be able to do that second piece.
That's right. Well said.
Which is the invest in the difference.
Well said.
So, this has been good. We got a few more minutes. I'm going to think a couple more comments and then we'll wrap it up. But I think, all right. Let me ask you this because I can't find a comment, but someone had said something about prepaid funerals as opposed to getting a life insurance policy.
So it kind of goes back to, so I'm not against that. I know some funeral homes do that. Usually it's attached to a funeral home, and they have it where you already pay for the plot. You generally find older people doing this. You don't find a lot of younger people doing this. You generally find like older people, like they generally have someone that already passed away already that's in that particular cemetery. But usually it's attached to a funeral home and paid up where they just paying for that. But again, that's just the policy just for burial. If someone is financially depending upon your income, you're going to still need a policy because yes, that takes care of that $15,000 burial. Now, what are they going to do come November of 2025? Right. How are they going to eat? How are they going to be able to pay for or still maintain the lifestyle that they had while the individual was here? So I'm not against it, getting something that's paid up, but generally that's for usually it's like older people that already accumulated wealth.
Got you.
That's the key component there. They already accumulated wealth.
Right.
And now they're like, okay, I know my time is ticking. Let me go ahead and get me something so that all my family, they're generally looking out for the family so that the family don't have to do a whole lot of stuff. That's why they get that policy. Right. They get that policy. Hey, this is what I got here. You go here, you do this. They don't have to worry about nothing but just going and setting the date for the funeral.
Right.
So there's nothing wrong with that. You can go ahead and get that. But for someone that's raising a family, who have people that is depending upon their income, that's not good enough. You want to have something that's going to be able to take care of the family. God forbid you was to depart this life.
So let me ask you, I know we said we wasn't going to get into the bias, right? But let me just ask you, and I think everybody can probably tell, but
I hope so.
Right. What type of insurance, life insurance, do you recommend?
So I recommend, and not only do I recommend, I have it myself. and that's a term policy. Term, and it's so funny because even the agents that sell whole life policy have term policies. That is the strangest thing to me. We'll be going back and forth. They're like, well, I got 300,000 in term. You got 300,000 in term, then why are you selling this?
Right.
So it's like, even they have term. Like when you do the research and you go through all the polls, the financial reports and the different financial books, all of them, even companies now that invest, I'm not talking about life insurance companies. I'm talking about financial institutions that are like dealing with people money. Years ago, they used to market whole life policies. They don't market whole life policies no more. As a financial advisor, because you know there's a difference. You have your financial coaches,
right?
Your financial advisors,
right?
As a financial advisor, they don't market whole life policies. The only people that market whole life policies are insurance agents,
right?
Because they get a chance to take advantage of too. And again, I'm not saying that they're doing wrong. I'm not saying that they have the intention to do wrong. I want to be very clear.
Right.
Some of them do have very good intentions. They want people to invest. They say, well, but the people are investing money. Maybe they may not have it for their whole life. They may just use it for the investment component of it. So I just want to be clear. I'm not speaking against anybody that offers whole life. I'm just saying for me, term, because I can get a lot of money for a little bit of premium. Exactly. Like Tom said, he was 42 years old and he was able to get a $500,000 policy for $42. That's $11. That's $10 a week.
Yeah, exactly.
That's exactly right. You go to Wawa and buy that on a hoagie.
That's right.
Something to drink.
Exactly right.
Like, think about that now.
Yep, that's exactly right.
His family is protected with 4 hoagies a month. 4 hoagies and 4 Wawa lemonades. His family, if he sacrificed, you know what? I'm not going to go to Wawa.
Right.
One day of the week, I'm not going to go there.
Right.
That's the policy.
That's exactly
right. So we have to get out of that mindset of life insurance must be a whole lot. You'd be surprised. People walking around spending $100 for $1 million policy that their family. That's true generational wealth.
That is. I agree. Somebody, I'm gonna put this question because this is a good question. I think you can probably answer this. Are policies honored if a spouse is not a U.S. citizen but both are married in a foreign country? So, I believe he's saying he's a citizen but his wife is not. But will they?
Good question.
Yeah.
So I actually had this identical situation that took place where the husband, and Taj know who I'm talking about.
Yeah, I was just thinking that. I'm glad. Go ahead.
You know exactly what I'm talking about. So the brother was here in America and his wife was in Dominican Republic. And we put the policy on him and the wife. And she eventually moved here, but when the policy was placed, she was still in Dominican Republic. So yes, to answer your question, the policy, whoever you have as a beneficiary on that policy, unless they're under 18, if they're under 18, they would have to be put under like an estate where once they get older, they can be able to get that, or whoever taking care of them can have access to that policy. But to answer your question, if they're both married and that one is not even here yet, yes, that policy. And again, this is predicated on the company too. So I don't want to speak for all companies. I just know, I know of a few companies. So I don't want to speak about everybody being able to do that. So certainly want to ask the question to whatever company that you're talking to. But most companies would definitely, they just want to, who's the beneficiary? Once they see who the beneficiary is, they would pay that, the proceeds will go to that beneficiary. So I know that because I dealt with that actual thing. The brother he got a policy. It was January 1st is when it was enforced. And then November of the same year is when he died. So, and it just was just a question. We were just talking, and this is why it's very, very important. Me and Todd were talking about this earlier. Life insurance, more people had it years ago because they had like the insurance man. and the insurance woman was knocking on doors. And they would come and, knock on the door. And most of our older generation, our grandmoms, they all had life insurance because somebody came to the door. But now in this demographic now, people are no longer knocking on people's doors, not for life insurance.
Right.
So unless someone that you know or affiliated with is bringing this information up to you and it's not taught in schools, you wouldn't know. And that's one of the biggest problems that we're having now.
Exactly.
People are they just don't know. They would, like I mentioned earlier, they would do better if they knew better. They just don't know. But to answer that question, yes, the person will still be paid out even though they're not here in the country.
And I'm going to say this because we're going to get ready to wrap this up. It's been an hour and 45 minutes. Don't even seem like it's been that long.
Wow.
Wow. It seems like it's been that long. But again, this has really been good, man. I really appreciate it. But I'm going to say this because I've seen this in the comments. Can't find, but some people were saying whole life is a scam. I'm going to say this. It's not illegal. Right.
It's definitely legal.
It's business.
It's business.
Right? It's business. So we know, like, when people say scam, I know what people are saying, right?
Right.
What they mean. But I'm going to say if it's legal, it's not a scam. It's business. It's just having the knowledge of, how things work and what works best for you as an individual.
Well said.
Because for some people, whole life may be the way to go, depending upon their situation, right? And I believe with Xavier Davis, he mentioned in the comment, depends upon suitability. And I do agree. It depends upon suitability, right?
He's right, because we're actually taught that when you go for your insurance license.
Mm-hmm.
So Xavier is certainly right about that.
Right. So I wouldn't say it's a scam, right? But it's not something, as you said, you would recommend to, a certain type of individual. And most people probably don't really need that type of policy. But again, it depends on your situation. So one must first look at their situation, but speak to someone that is knowledgeable, right? And has your best interests.
Well said.
Right, at the top. So with that being said, if somebody wanted to get life insurance through you, how can they reach out to you? Because you do provide policies to help people out, correct?
Yes. So they would be able to reach out to me. I'm not sure if I'm able to give my email.
Yeah, you can say your email, then I can actually put it in the chat, and then I'll put it in my description box also.
Definitely.
So, and I'm gonna say that I wouldn't invite. I'm the type of person, I won't invite just anybody up on my platform.
No, right? You wouldn't. You wouldn't.
So if somebody, I talk to some people and I look, man, because I often say, finances is a language. You either speak it correctly or you don't speak it. And I know you said one time, me and you all be talking in the past, how when you hear somebody talk about finances, your antennas go up.
Yes, it is, man.
Because it's a language, right? It's a language, man. And you can tell right away if somebody know how to speak the language.
Oh, for sure.
You can tell. You can tell. So
and that's why you want to be.
I'm sorry.
You want to be very, even when you're sitting down with somebody. Like I think me and Taj talked about this. I never close on the first night. It's all about education, right? I believe that what I have, it's a very good policy, so that I'm not worried about that part of it. Because if you come in and you're sitting down and you're talking to an agent, many times, keep in mind, they trying to sell you something, right? So many times you're going to have your antennas up. First night should always be just education. Talk about it. Talk about what fits you and your family. If that's something that we would want to do, even if you say, no, Mark, I need to do this right away, I'm going to tell you no. And if you move on, you go to another person, that's all good. At least I know I gave you the knowledge. Like Todd said, Todd got the knowledge. He went. I'm happy that he got it for his family. That's the key. He's moving from not having nothing to now having something. So I'm never offended by that. It makes me feel good to know that my brother was able to take knowledge that came from me and he implemented. Knowledge will apply. Knowledge is power. So yes, some people are going to try to sell you, but it's not just about the sell. It's about if you really love the people and want to look out for the people,
Exactly.
you're going to educate the people. And the education by itself should be the thing for you to make whatever decision that you want to make.
Excellent. So what's your email? I'll put it in the chat, and then I'll put it in my description box so if people want to reach out to you.
Definitely. So I just texted to you. So it's
okay. Drop the email in the okay. All right. So it's Marinnie.
So my last name, jr@gmail.com.
All right. So I just put it. So if you want to talk more to Mark Marinnie, you can visit him. This is his email. I'll put it up on this, so I'll show it. Make sure I spelled it right. Marinnie jr@gmail.com. So I will say that I see a lot of questions that were already answered, right? So people came in late, but some of these questions they asked were already answered. So I'm gonna just say I'm gonna post this video on the channel. So if you didn't catch the live stream, you'll be able to catch the replay of it, and you can get your questions answered. But Mark, before we go, any final remarks, any final words you want to say to the people?
I would just say, keep in mind, life insurance is, I heard a person say, is the last love letter to your family.
That's beautiful. I love that, bro.
Life insurance is the last love letter to your family. What
brother.
you don't want to do is depart this life and your wife, who's depending upon you now. Now, keep in mind, you got the beautiful car outside. You got the Gucci sneakers. Nothing. I'm not against none of that. You got the polo shirt that costs $100. You and your family are doing very well. You got subscriptions. Y'all eating out every night. Nothing wrong with it. Thank God for you. But you don't have life insurance. God forbid you was to die tonight. What is your wife's next move? What is the kid's next move? What if you're a single parent like we talked about? What do the kids do? Who's going to take care of the kids? So if you didn't get anything out of what we talked about, the awareness to getting life insurance is not something you want to hold off. Literally, when you get off of this live, you need to be, you and your wife or your spouse, the kids need to get together and say, what's our next move? Because again, this do you no good if you don't apply it. I can't tell you the amount of people that have passed away and had to go to GoFundMe. Go to GoFundMe.com and look at most of you that you see is people that passed away. That's 80% of GoFundMe is people that died. They could not afford to bury the loved ones. My father, my natural blood father, sat in the morgue for 2 weeks.
Wow.
Generally, a person is being buried in 1 week. They're buried in 1 week. He sat in the morgue for 2 weeks. When we seen him, they rolled his body into the funeral home, still had the blood on his mouth.
Wow.
Still had the garment, the hospital garment. And he sat there because we had no money. It's easy to say, oh, well, if we get to that point, we'll have it. That's not true in all cases. And now this is our last time looking at them. They burn them up because, cremation, burned them up. But the monies that was used to pay mortgage, pay lights, pay food, had to be allocated to pay for this. So how's the mortgage going to get paid? It wasn't paid. The refrigerator messed bugs all in there because in the month of August, you got to keep meat and stuff got to be frozen. The life it was upside down, all because my father did not have, or if he had it, we didn't know about it. We didn't know about it. So just think about that now. Who's going to take care of your wife? Who's going to take care of your husband? Because in some cases, the wife is the breadwinner.
That's true.
It's not always the man the breadwinner. The wife could be the breadwinner. If she depart this life, what is your next step? So if you don't hear nothing that me and Taj talked about today, you need to see life insurance is paycheck replacement. It replaces the income if a person passes away.
Excellent, excellent. I love that, man. The last love letter. I mean, that's beautiful, brother. I mean, and that's the truth. That's the truth. You know, as many know that my mother, she passed away last year, and she didn't have life insurance, but she had got to the point where she was self-insured, right?
Mm.
So we really didn't. Me and my brother, we just didn't have to. She had everything. We just her assets, right? So, but she had to get to that point. So
Yeah, that's
if you
right.
don't have, if you're not at that point, as one of the comments said, you need life insurance. And Mark, man, I thank you, brother, and
I
I thank
appreciate you having me on,
yeah,
man.
seriously, man. I think the people really appreciated this also for you coming on and sharing this information. And like I said, I won't just have anybody up here. You got to know how to
No, you
speak the
won't.
language.
That's true. No, you won't. No, you will not.
And like I said, you speak the language. You speak the language, and I hope the people can hear you. So, as I often say when I close out my videos, if you're ready to get off the rat wheel and you're ready to invest in yourself and become free to do what you want when you want, you can come visit me at TRUFinCoaching.com. I can help
Oh,
you
yeah.
out, get you on your journey to becoming free. And also, you can visit again if you're looking for life insurance. You can visit Brother Mark. Mark is Marinnie Jr. at gmail.com. Thank you for listening, and peace and blessings.